Good afternoon, everyone. Welcome to the BQE seminar series, today featuring our very own Professor Peter Carr. Dr. Peter Carr is the chair of the Finance and Risk Engineering Department at the NYU Tandon School of Engineering. Prior to his current post as full professor here, he headed various quant groups in the financial industry for 20 years. He also presently serves on the board of the National Museum of Mathematics, World Quant University, and two startups called Money SatNav and Life Navigator. Prior to joining the financial industry, Dr. Carr was a finance professor for 8 years at Cornell University after obtaining his PhD from UCLA in 1989. He has over 100 publications in academic and industry-oriented journals and serves as an associate editor for 8 journals related to mathematical finance. Professor Carr is widely cited. Google Scholar currently ranks him 3rd in the world in citations for quantitative finance, 2nd in derivatives, and 1st in volatility. He was selected as Quant of the Year by Risk Management magazine in 2003 and Financial Engineer of the Year by IAQF SunGard in 2010. From 2011 to 2014, Dr. Carr was included in Institutional Investors Tech 50, an annual listing of the 50 most influential people in financial technology. On a personal note, Dr. Carr is a wonderful person to work with. I have a particular affinity for the topic of his talk today. In February 2020, Peter and I discussed this topic in my office using my whiteboard as a visual aid. When NYU went completely online the next month, these preliminary notes remained on my whiteboard for well over a year. That's a record for longevity that may never be broken. Ladies and gentlemen, Dr. Peter Carr.
Thank you, Barry. So I want to make sure that people on Zoom can also see what I'm doing and hear me. So, so please let us know if that's not the case. So this is the title of this talk is Optionality is a Binary Operation, and I'll explain.
You need to share the screen.
Well, oh yeah, and I need to share a screen, right? Operation. So I'm going to describe what both words mean, and we'll start with binary operation. So the question is, what exactly is a binary operation? And so is there any way to move the things? So it's a calculation that combines two elements. The elements are called operands, and the elements have to come from the same set, and they produce another element in the same set. Okay, so that's obviously sounds very technical. Those through some examples, and so take addition over reals. So you take one real number like 3, you take another real number like -1, you add them, you get 2. That's a real, so it counts. Okay, and okay. So another example is multiplication over non-negative reals, subtraction over reals, and division over reals. But you cannot divide by 0, so you take 0 out. Okay, so those are familiar binary operations, but there are other examples that are less familiar. So so my favorite one is Einstein's velocity addition formula. So this is from physics, as you would guess. And so basically, so here's a thought experiment. So you took the subway perhaps to class today, and I know you've seen people walking on the moving subway train, and let's say they're walking towards the front of the train at say 5 miles an hour, and let's say the train is pulling into the station. There's 5 miles an hour being measured by somebody sitting down on the subway train, watching somebody walk by 5 miles an hour. And then there's also somebody else on the platform, and they see a train pulling at, let's say, 20 miles an hour. And they all have the windows on the subway train, so the person on the platform can see the man walking towards the front of the train. And the question is, if the train is moving 20 miles an hour and the man's walking 5 miles an hour, and you've got somebody on the train, what's the man's velocity for the person on the platform? So Newton would have answered 25 miles an hour. And that turns out to be wrong. So it's that's the main insight that Einstein had about time is relative. And so it turns out it's slightly less than 25 miles an hour. And this formula can actually be used to tell you exactly how fast the person is walking, needs to be by the person on the platform. So these velocities that we're combining, they're not actually 5 and 20, but they are as 5 divided by the speed of light, 20 divided by the speed of light. Okay, nothing to do with faster than the speed of light. So those numbers are between 0 and 1. And we actually allow in the slide experiment someone to move opposites the way light is traveling. So as a result, the number is minus 1. So you combine these two numbers, which are the velocities, 5 and 20 divided by the speed of light, which are actually between 0 and 1 in my example. You combine them using this formula, which turns out to be this formula as well. And this formula is actually more understandable. So, well, perhaps. I mean, so, depends on where you're going to function, but basically it's going to map numbers inside 1.1 to the real line. Then you're going to add them, and then you're going to add back to 1.1. Okay? So you're going to end up with a number in the same set, which is Einstein's sum. Okay? So here's the main point, that this is not just mindless mathematical abstraction. This is our universe. Okay? So you really cannot add 20 to 5 and get the right, ordinary add 20 to 5 to get the right answer. Okay? So it suggests that these ideas actually have relevance, at least for physical universe and perhaps for finance too. So for finance, I'll actually remind you of a familiar example. So this could be an interview question one of you might get. So you're thinking as an American of investing in British Airways. British Airways trades in Britain, and if the stock price is denominated in British pounds. You have in your pocket dollars. So the way you would invest in British Airways is you would convert the dollars in your pocket to pounds now. You would then buy British Airways stock with those pounds. You would wait some time, let's say a year. You would then sell British Airways stock for whatever is the random price in a year from now in pounds. And then you would convert that random pound amount back to dollars using whatever the random exchange rate would be from now that converts pounds back to dollars, right? So, okay, so there's this notion in finance called volatility. And it's a measure of the spread of random variables. And we have two random variables in this problem. We have British Airways return over the year you hold it, we held it. And we also have how much the exchange rate moved from its initial level, okay? So the, let's say the two volatilities are, for example, 0.3 and 0.4. Okay, so 30% would be, say, the volatility exchange rate, and 0.4 would be the volatility of share rates. So if somebody were to ask you, you do this round trip, dollars into pounds, pounds into share rates, blah, 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 what's the volatility of your entire investment? So and they also told there's no correlation between exchange rate and the share rates return. Then the wrong answer would be to say 0.3, ordinary out of 0.4, and say 0.7. The right answer is to calculate variances. So it turns out that the variance rate is 0.09 for FX, 0.16 for British Airways. You have variances and then gets the rate. Okay, so that turns out the answer turns out to be 50%. Okay, so you combine 30%, 40%. You clearly have two random variables that, if they're independent, the volatility, the overall investment should be higher. And it's actually 50%, it's not 70%. Okay, so that's also a type of addition. We're actually going to use this type of addition in a different application. Okay. So I need to advance the slide. Any ideas on how to do that? That way? Yeah. Okay. All right, I'll do that. Okay, so binary operations can have various properties. So ordinary addition, ordinary multiplication, they're both commutative. So A with B equals A, B times B with B times A. And but that doesn't hold for subtraction or division. They're not commutative. Binary operations may or may not be associative. Okay. So an example of an associative binary operation is multiplication. And let's say an application of associativity would be you're trying to calculate the volume of, let's say, well, I can't find it, but the brush, the one we use to erase the board, and it's got a height, it's got a length, it's got a width, and you know, so it doesn't. You can actually compute. Let's say you combine the two numbers. You can do height times length and multiply the width, or you can do length times width and multiply the height. You get the same answer, right? So multiplication is associated, addition is associated, but I'll show you a binary operation that's not associated in a minute. And also a binary operation may or may not contain a neutral element. So the neutral element for ordinary addition is 0 because you add 0 to any number and you get the number back. The neutral element for multiplication is 1. If you multiply any number by 1, you get the number back. And I'll give you another example on the slide. And so the set over which a binary operation is conducted may or may not contain an inverse element for that binary operation. So what's an inverse element? So for addition, and let's say for the number 2, the inverse element is -2, and that's because 2 plus -2 gives you that neutral element. Okay. So for multiplication, if the number is 2 and you're asking what's its inverse element, it's 1/2, because 2 times 1/2 gives you the neutral element, which is 1. Okay. So boy. So I want to illustrate these ideas for a particular binary operation on the next slide. So an important fact for us is that the maximum of 2 elements is a binary operation. So the maximum is, in other words, the larger of 2 elements. Okay? And so take the set of non-negative reals. Okay? So that's 0 up. And consider as a binary operation the maximum of 2 numbers. Okay, so if I give you 3 and 4, the max is 4. Okay, and that turns out to be commutative. Turns out maximum is associative. Maximum has a neutral element, which is 0, because the max of a non-negative number is 0 is a non-negative number. Okay, and but over the set of non-negative reals, maximum does not have an inverse element. So here's the way to think about that. So if I told you that a number is, say, 4, and so we know the neutral element is 0, so the question is, can you combine some non-negative real with 4 using max to get to 0? No, good luck. You cannot do that. Okay, so there's no inverse element. And okay, but what is really important about max is that any increasing binary operation distributes over max. So examples would be the addition of 2 numbers is increasing, right? You add 2 to 3, you get 5, it went up. And if you so to distribute means that basically okay, so let's do a concrete example. So first, you're doing the max of 3 and 4 and it's 4. And then we're illustrating the addition distributed over max. So we're gonna ask, what's 2 plus this max of 3 and 4? So it's 6. And now let's do a different calculation. What's first 2 plus 3, 5, 2 plus 4, 6. What's the max of those? Those the order change. It's 6, same number as we got before. So that's distributing. So okay, now it's not just addition that distributes over max. It's multiplication that distributes over max. So that's increasing. You could also take a power of a number and call that a binary operation. Okay, that would distribute over max. I mean, so there's all kinds of funky binary operations we're going to see, and they all distribute, they're increasing, and they all distribute over max. So, okay, so another example of a familiar binary operation distributing over max is ordinary multiplication, and on the set of non-integer reals, ordinary multiplication also distributes over ordinary addition. You'll probably taught that in third grade or something. So now, does ordinary multiplication distribute over other binary operations besides max and plus? And so if you think about that, okay, the answer will be yes. And also noting that plus and max are both associative operations, is ordinary multiplication distributed over other associative binary operations? The answer will actually be yes as well. Last bit of math I want to get across, and we'll switch to finance, is algebraic structure. So in math, an algebraic structure is a non-empty set. We'll call it A, some median, a collection of one or more binary operations defined on A, and a finite set of identities known as axioms that these operations must satisfy. So, an example of an axiom that might be required is distributivity of one binary operation or another. And you can start to classify algebraic structures by how many binary operations they contain. There are algebraic structures with just one binary operation. The most famous is called a group, but we're going to be interested in other ones, other algebraic structures with exactly one binary operation. So, believe it or not, this funny term will be relevant when we talk about the Black-Scholes model. And this funny term will be relevant when we think about an alternative to the Black-Scholes model. Okay. And what is a unital magnum? I'm not expecting any of you to know. So we'll start with a magnum. It's an algebraic structure with one binary operation. You have to have closure or we wouldn't be talking about algebra. And that's it. So the word unital means that there's a neutral element as well. And so with a mono, it means we actually add additional structure. So besides being closed and being a neutral element, it's associative. And so then you get to a mono. So, but there's not necessarily resistance of the inverse for a mono. And so there's also algebraic structures with two binary operations. The most famous one is called field. And if you consider ordinary addition, ordinary multiplication over reals, that's a field. But less famous ones are, say, rings. But we're interested in something else yet again called ringoid. So what's a ringoid? It's a algebraic structure with two binary operations. And all you ask is that one binary operation is distributed over the other. That's all you ask. Okay? That'll turn out to be useful for Black-Scholes, although there'll be some additional structure as well. Semi-fields are also going to be useful for us. So what are they? Well, let's start with a field. So a field is when you have two binary operations, and they're both groups, and one distributes over the other. So groups, to remind you, we have closure, of course, a neutral element, and associativity and inverse. And so That's a field where both binary operations have all its properties and one is equal to the other. So think of multiplication, distribution, over addition, they have all its properties. When you're doing over here. Take away one property and you get a semi-field. The one property you're going to take away is the existence of an inverse for the addition. Okay, so for example, I told you that multiplication and addition of reals is a field. Now, if you make it over non-negative reals instead, then it becomes a semi-field. So just considering multiplication, addition, the ones you were taught in third grade, over non-negative reals, that's actually a semi-field. So you don't necessarily have the existence of an inverse on the addition operation. Why is that? Because so if the neutral element is 0, and if I say what's the inverse for say 3, then you're tempted to say -3, but that's not in the non-negative reals. Because 3 plus -3 equals 0. It's not in the non-negative reals, so it's almost all right. So anyway, there are algebraic structures with more than 2 binary operations. Here's one with 3. I actually call this just for myself a swing field. So ordinary multiplication, ordinary addition, and max are the 3 binary operations. Then ordinary multiplication distributes over addition. I believe I told you that addition distributes over max. And the reason, let's say, we're working over reals, including minus infinity, is minus infinity is the neutral element for max when you're working over reals. Why is that? Because if I give you a real number, say -4, and you max it with minus infinity, you get -4. So it's in the minus infinity is the neutral. And okay. So anyway, if you're interested in seeing this applied, I'm giving a talk in 13 days that is online and you can easily attend. So let's move on to some finance. Okay, so the title of my talk, I had the word binary operation, and you know more about it than you ever thought you ever would. And now we're going to talk about optionality. So what's that? So it's a finance term, and it describes the contractual ability of a security holder to choose between 2 or more alternatives. So we're going to first consider optionality as exactly 2 alternatives in order to relate optionality to a binary operation. Okay? So examples. So you probably all know what payoffs of European calls are, and it's a max of 0 and a forward contract value. So you have 2 alternatives. You can either get 0 or you can have a forward contract value. You want to negative. So you choose the better. Okay. And so that's an example of a contract optionality. Let's try a different example. Verbal bond. So whenever a verbal bond can choose, and in practice it's at any time, but only European style, so only maturity, between having the bond or having n shares of stock. Okay, so n equals the ratio. And another example. So there's a portfolio of 2 securities, which we'll call married put, and it's a portfolio of 1 European put, and the 1 is the asset that the put is written on. Okay, so a put, as a reminder, gives its owner the right to sell an underlying security for a fixed strike price. And if you actually own that put and the underlying security as well, put them together into a portfolio, then maturity, there's going to be a thought process. Let's use an example. Strike price 100, and let's use Morgan Stanley as the stock price. So today was earnings day, and it did well, and the stock price went through 100. So anyway, if you had a put struck at 100 on Morgan Stanley, then let's say before earnings were announced, the stock price was say 99, and you could exercise then, you would, and then $1, which is the put. But after earnings were announced, the stock price went up to say 101, and then you would not exercise the put. And so if you are exercising the put back in 99, we're thinking you also own the shares of stock, so you get to deliver the shares of stock and walk away with 100. Okay, so I don't know if you follow all that, but it ends up if you own put in the stock, you either walk away with 100, that's if you exercise early, or you walk away with 101, that's if you don't exercise. And just hold the shares of stock with 101. Okay, so okay, so you're getting the optionality over single periods between the larger 100 and 101, because like the 101 is random and the 99. So you're getting the larger 100 and the variable. So it's the married put is optionality. And we're going to be very interested in this particular portfolio called the married put that pays the maximum of a fixed amount and a random amount. And we're actually going to consider married puts written on married puts towards the end. Okay, and so I just went through this example, but the payoff if the strike in 100 when the underlying standing stock price is going to be larger of the strike price and the stock price at expiry. And throughout this talk, we're going to work with models that value things that do not allow arbitrage. And moreover, we're just going to zero out carrying costs for the underlying asset for the option. So interest rates and dividends. So we want to value married put. The current stock price is also 100. Okay, and the strike price is 100. So there's a tight up or down on the value of married put. Again, it's being the larger of 100 or the stock price is. The tight up or down is 200. Why is that? Because you can buy a bond for 100, you buy the stock for 100, you hold the security, and then you have both assets. Whereas if you have a married put, you're only getting the larger of the two assets. Okay, so better to both than to have one, right? So it's actually tight up or down because there's a model that for a married put value that actually reaches 200 in this example. That model is called Black-Scholes. You'd have to make the volatility infinite, but so what? Okay, and okay, so we're finding that the up and down is a straight sum of the strike price and the current stock price, and we'll call the ordinary addition is a binary operation. Now there's a lower bound on the married put value, and it's intrinsic value. Intrinsic value, if you're not familiar with the term, is for an option, it's roughly speaking, it's what the value would be if the volatility was 0, say. And so for a married put, if the volatility was 0, then you're getting the larger of the strike price of 100 and the current stock price of 100 because it's not removed, and that's 100. So the maximum is also a binary operation. We went through that, and this lower bound of the maximum is tight, meaning it can be reached in some model. Again, you can make the Black-Scholes model be the model. If you set volatility 0 in it, you'll get intrinsic value. So we're seeing that the two bounds on the married put value are both binary operations. Okay, but could the married put value itself be a binary operation? And if so, what properties does it have? So let's go through that question in the context of the Black-Scholes model. The PMS stands for Black-Scholes. So K will denote strike, S will denote spot, capital T will denote maturity date, signal will denote the volatility is constant in the Black-Scholes model. So volatility turns out to be units 1 over square root of year. So if you multiply by the square root of time maturity, you get what people call dimensionless vol. So we'll denote dimensionless vol by the letter D. We'll call it black vol for short. It's dimensionless. And okay, so the way you value in, say, the Black-Scholes model, you have to take expectation on your residual measure. And let's say if there were interest rates, we would discount but with 0 interest rates. So you have to take expectation of the payoff. The underlying is logically distributed, and we're actually going to work with a mean one log normal random variable. So the reason for the mean one restriction is we're actually thinking about the price ratio. Okay, so if the price of maturity of log normal distributed is 100, and the price today is 100, then the ratio of that log normal mean 100 to 100, that ratio is mean 1. So okay, so the we describe a log normal random variable with two numbers. The mean is one of them is 1. The other number is going to be this letter b, which is dimensional small, and it's actually the standard deviation of the log of the log variable. And so anyway, so the terminal price of the married put is the current stock price that you know, say 100 times the mean one random variable, and this log normally distributed. So the payoff of the married put is when the larger of the final stock price and strike. So that's just the payoff. What about the premium, also known as the price? So the payoff is again at the top of the slide, which is the dollar. And if the price today is 0 under 0 interest rates, you take the mean under a safety measure. And so there's a formula that's similar to but not identical to the Black-Scholes formulas for puts and calls, and this is the formula. Those Black-Scholes formulas for puts and calls involve minus sign here, and but married put you can see the plus. And so this is the formula in all its gory detail. And I shouldn't memorize it or anything, but let's say just some of the features is that you're weighting the strike by this Q norm, and it's probability P01, and it actually has an interpretation, which I have on this page. And you're also weighting stock price by Q norm, so that's probability P01. Also has an interpretation on the next page. So there's that formula again at the top. And here are the interpretations, which weighting strike by is the risk to probability that the random stock price is less than the strike. And what you're weighting current stock price S by is the so-called share measure probability that the stock price is greater than the strike. Don't worry if you don't know that term, share measure, but like basically there are actually multiple so-called marginal measures. And if you use the stock price as a numerator to define one of them, we call it share measure. Okay, so we can take that formula at the top and think of it as a binary operation combining the strike price and the stock price, for each fixed level of volatility. Okay, so first you have to fix a vol level. So V is our vol, and V is sigma time maturity. So fix it at say 0.75, for example. And then for that fixed level of vol, you just have to combine the only other variables are stock price and strike price, combine them, and now we can buy the Black-Scholes formula for married put. We'll call that a pseudo addition of some kind of the strike and the spot. Okay, and so we're introducing a binary operation that shows you the note that way. Okay, so it depends on the volatility. So V is the volatility dimension. So that's indicated. So you can ask what properties does the binary operation have. So it's commutative, so you can check if you switch the order of strike and spot in this formula, you get the same formula. And it has a neutral element, which is 0. You can check if the strike is 0, you got a married put, you get 0, you get the stock price. Or if you set the stock price is 0, you got a married put, you get the strike price. And so let's say we have an algebraic structure that's describing every put valuation in the Black-Scholes model. We're working over the set of non-negative reals, strike price, stock price, and married put value were all non-negative reals. And we use this to combine strike price and stock price when the neutral element is 0. And so it's called a commutative universal magma. And but this binary operation turned out to not be associative. Okay, so you have to check it to see if it is. You use numbers and see it's not. So, but ordinary multiplication does distribute over this, Black-Scholes addition for married put value. And so we actually have an algebraic structure with two binary operations, ordinary multiplication being one, which we're used to, and this one that we're not used to, sort of a pseudo addition. Okay, it's not associative. And so, you know, glad to say, what is a name for this algebraic structure with two binary operations? I mean, it's a commutative ringoid, so if you call ringoid means that this is true over that. And moreover, there's additional properties. So, I mean, that's the ringoid, that's all you need is distributivity. Meanwhile, this one also has a neutral element, 0. This one also has a neutral element, 1. Moreover, that one has an inverse. So, you know, so there's additional structure and times the structure. But that one's not. Okay, so we've been valuing married puts, which is a pretty simple financial product. It's European style payoff with paying a larger two numbers, one being fixed called the strike price, one being random, being asset value. So we're going to actually introduce a much more complicated financial security and show the power of these abstract algebra methods for valuation. So this new path-dependent security I'm going to introduce does not fit. It's my idea. And I called it a stoption. I gave a talk last year, and at that point I called it a market mulligan, and I still haven't settled on the name. Market mulligan actually came from a market at Morgan Stanley, and I feel like I've done better than that. So anyway, and so what's a stoption? Okay, I'll tell you in a second, but let me review some basic facts first. So consider, you know, that you invest $1 in some asset, say a stock, and you hold it for n periods. So there's a term in finance called gross return. So a gross return is a price ratio. Okay, there's no dividend, which is what we're saying. So so the you know, so if you just hold, you know, so if you invest $1 in an asset and hold it for some length of time, so n days, and then sell it, you ask what do you get? So you get so the number of shares you can buy is 1 over F0. Okay, so if the current stock price is say 50 cents, then you can buy 2 shares. Okay, and then when you sell the 2 shares, you get 2 times whatever the stock price is then, right? So the payoff is actually the final stock price divided by F0, say half of the cost of 50 cents. So and so you know, it's a very simple thing that for $1 investment you get the price ratio. Now, if you're a mathematician, you can make something simple and make it complicated. I'm a mathematician. So you can write that that price ratio S final over S initial as this. Okay, so these, you know, let's do a 2-period example. So we have S2 over S0. You can write that as S2 over S1 times S1 over S0. Okay, that's what I'm doing. Okay, this would and not necessarily fit. And so let's say, so you know, the takeaway is it's very easy to get exposed to the product of the ongoing gross return. Just need $1 to do it. And okay, so you know, let's say as an investment strategy, that works great unless you know you buying Lehman Brothers on September the 12th in 2008, and you know by September 15th you really regret that decision. Okay, so so that's the issue, that you have a really adverse daily gross return, and so let's say it's common to think about ways to provide so-called portfolio insurance, okay, for investments. And so we're going to provide a form of insurance on your investment, of course, for a fee. And this is how it's going to call a stoption, and here's how it works. So first, it's as a type of option, it's the muted style. So you may or may not be familiar with this term. So you probably heard of the European style options, I mentioned them earlier. American options can be exercised at any time. And just as the country of Bermuda, the island of Bermuda is between Europe and America, Bermudian options have a sort of payoff structure that's in between European and American options. So for Bermudian options, exercise it at any one of several days. Famous example of Bermudian Stoptions, a gentleman in the front row knows a lot about this. And so we're going to be having Bermudian exercise style in this investment instead of stock. And so if you buy one of these options, what do you get? So you can exercise in any one of several days. It's an end-day contract. You can exercise in any one of the end days. And then if you exercise, what you're getting in cash is the prior gross returns multiplied up times the contractually specified amount. So what you're actually doing if you exercise on page J is you're replacing the gross return on page J with a number that's in the term sheet. Okay, so this little GJ is a guaranteed amount that's written in the term sheet. Okay, so let's say it's a 2-day option, keep it as simple as can be. Then you could exercise at the end of the first day or exercise at the end of the second day. If you exercise at the end of the first day, there are no prior effects. You're just going to get a number that is in the term sheet, we'll call it G1. If instead you exercise at the end of the second day, you're going to get the first day's gross return, which is times 0, you don't know, times G2, which is a little G2, which is the number that's in the contract. Okay, so you end up, if you exercise on the second day, replacing the second day's gross return with a number. Okay, and you have to exercise the way this works on one of the end days. And so one of the questions is, like, we're still going to be looking at a $1 investment, but now you have this added feature. It's got value because you can, it would be nice to replace a very low gross return like near 0 with a number in the term sheet that's above it. So that's the way Stoptions work. If the exercise in day J, the last random gross return that's just realized is replaced by a guaranteed amount in the term sheet. Okay, and you have to exercise once. Okay, and so now we're thinking about valuation of this funny thing, and the payoff is non-negative. So from some basic considerations, the market price is non-negative, and we can use a model to get the exact value. Let's use Black-Scholes, and so we just need sort of a discrete time version of Black-Scholes. So Black-Scholes model is actually continuous time, but we're monitoring the path daily. So we just need to ask what are Black-Scholes assuming about daily gross returns. So the answer is they're assuming that the end daily gross returns are IID, which is independent identity distributed, and log distributed. Okay? So the discrete time stock price process is Markovian in itself, and you can use backward induction to value the stoption. It's a bit of a tedious exercise, so I'm just going to show you the answer. So we'll denote the value of the stoption by this. So the subscript 0 means at times 0, and the superscript in brackets tells you how many exercise opportunities you have at time 0. So if it's a 2-day stoption, you have 2 exercise opportunities. And it's not obvious, but it turns out that the value of the 2-period stoption is just the value of the married put. When the strike price of the married put is the first floor, G1, and when the value of the current stock price is the second floor, G2. I don't expect you to understand why that is, but trust me, it's true. So we're going to use the married put valuation formula from Black-Scholes to value the 2-period stoption. Okay, and what if it's a 3-period stoption? Then it's actually like basically a married put with not married put. And so you value backward induction, so you value this underlying married put, and then you value this married put with not. Okay, and you have to, the brackets have to stay there. Okay, so if this were ordinary plus, which it's not, you can use the brackets, but it's a very unusual pseudo addition, which is not associated. So you cannot remove the brackets. So it's not a big deal though that you have to do it and just combine these two numbers in that order. And then having done so, combine these results. It's not a big deal. I mean, the fact that you have to do them in this order doesn't slow you down. Okay, it's just, you know, you got three numbers to combine, and I'm demanding you do them in a certain order. I mean, you know, the only time there might be an issue is if there's an overflow problem on the computer, then you might have the flexibility to do numbers differently. But aside from that, it's the same as if it was associative in terms of computation time. And okay, and just more generally, especially the capital N, the value of an n period Stoption in the Black-Scholes model is given by this expression, which is closed form because as long as n is finite, that's just a finite number of calculations. And so it's fairly remarkable that we have a simple formula really for a pretty complicated product. Okay, so this product is, so you understand, it's path dependent and it's Bermuda style. Okay, and you know, anybody who's worked in the industry knows that typically you resort to numerical methods when you're dealing with those kinds of products. But actually, this is not a numerical method. Well, it could be as well, but it's actually a formula. Okay, so okay, so so let's say the product and the model work well together to produce a simple closed form formula, and we wonder if it can be made simpler yet. So so I don't like those brackets at the bottom. Wouldn't it be nice if we could write down something similar to that bracket? Okay, so so that's what we're going to try and focus on next. So the way we're going to proceed is we're going to fix the contract. It's still going to be a stoption. We're going to change the model. So although the Black-Scholes model is very famous, it doesn't necessarily work. Okay, so so you know, one of its many implications is that when you graph implied vol and option across stripe, the graph is flat. When we look at data, it's never true. So you know, maybe there's an alternative model to Black-Scholes, which not only closer to reality, but moreover makes the valuation of the stoption easier. Okay, so that actually turned out to be true. So the model that we're going to propose as an alternative to Black-Scholes has a name. You would not have heard of this model because I made up the name, and the name I made up is Conjugate Power Data Model. And that's a lot to digest, I know. And so let's start to digest. And okay, so basically, instead of assuming the price ratios are IID log normal, we're now going to assume that price ratios are IID, but the common distribution is the so-called conjugate power data distribution that you're not familiar with. Like the log normal, the mean of this grand variable will be 1, and like the log normal, it doesn't mean that a parameter to fully describe it. And what's a little bit different than log normal is that this additional parameter to describe the spread of outcomes is actually forced to be in the interval 0, 1. So volatilities in Black-Scholes model are not forced to be in 0, 1. It does turn out when it names that they happen to be in that interval, but take Tesla is above 1. Okay, so okay, so whereas you know, so this is not a volatility, we're calling it a dispersion parameter. It's bounded, it's forced to be bounded to 0, 1, so we use letter D to describe it. And we'll give it a name, it's called bewilderment. That's just our own name. It's just trying to measure your spread, you know, the spread of outcomes. And I'll tell you how to think about it mechanically in a minute. So, okay, so we'll get an even simpler formula for stoption. And that formula will just be a so-called LP norm of the n guaranteed gross return, little g, in the stoption term sheet. So if you don't know what an LP norm is, you'll see the formula for it. And so what I first want to do is show you this Dagom distribution, which is an alternative to log normal. And in a special case of it, it's called conjugate power Dagom that we'll actually use. Okay, so Dagom in 1977 proposed a 3-parameter distribution actually. We see the cumulative distribution function written here. And so the 3 parameters are mu, p, and q, and they're all positive numbers. And so we actually want a 2-parameter thing compared against log normal, which is also 2-parameter. So we're going to impose a restriction on 2 of the parameters p and q. This is a restriction that whatever k is 1 of 2 equals 1. So those P2 numbers into powers, and so it's a standard math language. We're saying the powers are conjugate. So we're, as a reminder that we're have this restriction in place, we'll replace this parameter P here by its reciprocal. And so we're going to define D as one over P. And so P gets replaced by 1 over D. D is defined as 1 over P, so it ends up being the thing. And so anyway, but now it's a two-parameter model. U and D have two parameters. And U in the two-parameter model is the mean. Okay? Turns out this mean is actually not the mean when you have three parameters. So it's a good idea to do this restriction, and it also aids in comparing against log normal, as I mentioned. And so if you know the volatility and you want the bewilderment for this conjugate power Dagan distribution, here is a way to go back and forth between them. This is my now favorite way. I worked with Tony in the back on different ways I remember, and but actually I think it was the one we first thought of. So the log with a 2 subscript is log. So that's a way to go back and forth. It comes from equating married put at the money married put values in the two models. Here is a graph of the PDF of the log normal. The log normal is this yellow dashed one, and the conjugate power Dagan one is solid blue one. So if you look closely, you can see the tails are thicker for the conjugate power Dagan. And that's actually formally true. So, it's not just this example, it's always true. You can prove it mathematically. And moreover, it's not obvious, but there's negative skewness in this conjugate power Dagan distribution, the width like of the log. So, okay, so the standard way of thinking about skewness is that if the distribution is log normal, then you first take the log of it, then you get normal, and then you look at the skewness of that, which is 0. Okay. So likewise, conjugate power Dagan, if you take the log of it and then look at the skewness of that, it's actually negative. Okay, which is what you see with many underlines, including say S&P 500. So it's actually more realistic for most underlines, but I can't say all. Okay, so we're going to consider a standard conjugate power Dagan CDF. The standard is just one parameter, which is D, which is bewilderment, which is measured spread and counting. And the mean is in step 1. So let's say you want to value married put first, and then we'll gradually stop from after. So you want to value married put, and the strike price is now some level G1, and the current stock price is G2. You have to take the mean of payoff using the capital G is conjugate power Dagan distributed and standardized. This is what you get in formula trust. Okay, so the way you can describe this in words, this formula, is it's an LP norm of a 2 vector whose 2 elements are G1 and G2, where normally wherever you see a P in the LP1 formula, you put one of the P instead. So you can interpret the P in the LP norm as precision. Okay, it's the reciprocal of spread. Okay, and okay. Okay, so I realize I'm running out of time, so we started late, though, so people are late. And so here's the formula again for married put. Let's illustrate it with a simple example. And like that's the beauty of this alternative model. It's actually simpler than Black-Scholes. Okay, so Black-Scholes is considered simple, and this is simpler. Okay, so you're gonna be able to do exact calculations in your head for numbers chosen carefully, let's say. So this bewilderment B, it needs to be between 0 and 1, so take it out. The strike is any positive real, we'll take it. The underlying street price is any positive real, we'll take it for. And we want to price married put, strike free, paying the max of the strike and the street price maturity when the mean of the recent mean of the terminal street price is the current price of 4. So if okay, so you just think about bounds for a second and not the particular model. The lower bound is the intrinsic value, which is the max of 3 and 4 or 4, and the upper bound is the sum, so the sum is 3 and 4 and 7. Okay, so we need all models need to deliver a value in between the lower and the bound. And if you use a particular conjugate data model with these parameters, you actually get 5. So we're using, we're doing the calculation, and that's the calculation I've seen before. And so it's famous Pythagorean triple. So, okay, so that's pricing near input. You're more familiar, I'm sure, with vanilla inputs, so all you got to do is subtract the current price underlying. So the current price underlying, in this example, was 4, so the vanilla put price would be 1. 5 minus 4 is 1. And so once you have the put price, you can invert from implied vol, okay, Black-Scholes implied vol. You can do it for that at the strike of 3 and the tree gate that we're using, but you can also do it for any strike, any tree. Okay, so you could wonder, how does implied vol graph in this model? And so there's an answer. There's the answer. So, I'll remind you the Black-Scholes model is graphic flat. Okay, so this is clearly not flat, and the heavy tails that I told you that the conjugate distribution has is manifested in a smile. Okay, so implied vol is really smile. So, so the model is, somewhat realistic for certain underlyings. I won't say all. And okay, so let's say the nice thing about this model is that you get this very simple formula for very quick value, and there's a certain form for this formula, which is that we're making 2 positive reals from 1 to 2. We're raising them to the same power 1 over p. The result is a positive real, then we're adding, and then we're sort of raising the sum to reverse the reciprocal of the power is 2. So if 1 over b was 2, then b would be a half. And so the more generally, you can consider having some generator, which in this particular example is gradient of b, but you can have some generator which just needs to increase the function, actually even more generally monotonic. And then anyway, as a monotonic function is an inverse. And so this is the generalization of that, and especially here is a power function. So if we consider this structure, that turns out to be the structure that any associative binary operation has. Okay? So there's a famous theorem by Tandon and Axel that we want to describe an associative binary operation that all have this structure. So if we want to combine G1 and G2 with an associative binary operation, there must exist a monotonic generator such as this is true. Okay, that's how you get the pseudosum. So we have a pseudosum here. It's said to be isomorphic to ordinary addition when the generator is the power function. So it turns out, so I'm going to start skipping slides because we're running out of time. It turns out that if you want to work on non-negative reals as we've been doing, and you want a binary operation that is associative to value under input, then it turns out that this power example is the only one that you can use. Okay, so that's kind of a shock. Basically, that associativity requirement is strong. Okay, it really reduces the set of models we can consider. It's conjugate power dating, and that's it. Okay, as long as we're working with non-negative reals for the underlying. So, so crude oil futures, were thought of as non-negative reals for a long time, but last year it actually made a quote, and so people started thinking about them as real values instead of non-negative reals. And so then, if you're thinking about an underlying that is more negative, interest rates are another example, then you don't have to use the conjugate power data model. There are other associated binary operations for those sets. Okay. Okay, but again, you're going to have weakness depending on the set you're working with, actually. So it turns out if you want to consider, for example, interest rates on the whole real line, and you want an associated binary operation, there's a particular model just for the distribution you have to work with. It's called the logistic distribution. Okay, that's what it's going to be. So this associativity is really narrowing down the model, and let's say you have to decide whether it's realistic or not. But the big advantage of associativity is that
when you want to value a stoption, you can basically drop the brackets. And so let me skip through some things. And I'll just show you a formula for a stoption value in the conjugate paradigm model. And so I'm skipping the derivation, I'm just showing you the formula. So you have an end period stoption. And now the price ratios are IID conjugate paradigm as opposed to log normal. And these G's are the floors to stoption. These are the amounts the return sheet you can swap any gross return for. And anyway, this is the formula for an end period stoption. So it's an LP norm of an end vector. And so basically we drop the brackets. Like let's say, I mean, this is also a formula for the circle plus B being the very quick value binary operation that I showed you for the conjugate model. So like a point of view is that the valuation formula in this pseudo arithmetic is just the repeated sum of the repeated pseudo sum. So this is in some sense simpler, but you're not so familiar with that. So maybe you want to translate it into more familiar things like ordinary addition, so fine, you can. So this is the formula in terms of ordinary addition being used. Okay. Okay, so this demanding associativity has advantages beyond being able to drop brackets. So you can have explicit formulas for when you exercise, and moreover, how to replicate the stoption by trading in cash and one-day calls if you're monitoring daily. So I'm skipping the details for lack of time. And now let me just summarize. And so with a concluding example, so we're going to do a 3-day stoption. And so the 3-day stoption, you have to exercise either under 1 or under 2 or under 3. And so so there's a below-limit parameter in the conjugate paradigm distribution that needs to be between 0 and 1. Let's make it a half. There's also 3 floors that are specified in the term sheet or 3-period stoptions. Let's make them 12, 4, and 3. And so let's apply a formula I showed you and the number of opportunities is 3. And this is the calculation we have to do. And because it's associative, what you can do is you can first combine these two, and we've seen actually that that's 5. And then combine 5 with this, and you get 13. So it's another Pythagorean triple in action. So I'm using the fact that 3 and 4 and 5 are Pythagorean triple, and 5, as I just said, and 12 and 13 are another Pythagorean triple. So, and so you can calculate sort of when you should exercise in closed form, like the sort of conditions for exercising, basically a low enough gross return, then you should exercise that day, and how to replicate it. So, okay, so the okay, so it's a the model makes life easy, and the spirit is, let's say that if although derivatives valuation is considered nonlinear, because payoffs are considered nonlinear, the notion of linearity actually depends on the binary operations themselves, right? So you were taught in high school probably that a function of a plus b times x is linear. Okay, but later in college, maybe you learned, depending on what you took, that there are other binary operations besides plus and times, and there can be binary operations like pseudo plus, pseudo times, that have all the same properties that ordinary addition, ordinary multiplication have, like pseudo times, pseudo over pseudo plus, etc. So you can basically take a situation which is on the surface is nonlinear in the classical ordinary addition, ordinary multiplication glasses on, put it on pseudo glasses, and suddenly you see it as linear. Okay, pseudo linear is a better term. So the Stoption valuation is an example of that. So I'll just go back so you can see it clearly. So let's say we've got 2 formulas. This one I would call pseudo linear for G, okay?
And this one, I would call nonlinear and, using NGs because we changed the list. Okay, so, but they're using the same number. Okay, so everything you learn about linear algebra applies here as long as you make the right changes. Okay, so it's a fantastic way to deal with nonlinearity when you can. Okay, so I'm not saying you can always do it. Okay. All right, just to wrap up. I mean, basically, this Mary Cook valuation function, the quantity valuation model, is special, but it's the only one that supplies an associated binary operation. And if we take this below limit parameter p and send it to 0, we get the max, and so that's the intrinsic value. And max is even more special because basically everything distributes over it. So whereas for the circle plus b, like the only thing that distributes over it is ordinary multiplication. Okay. And I just comment that somehow it turns out in derivatives we spend a lot of time staring at the max of things, and so it didn't have to be that way. If if let's say derivatives markets were invented by Fourier, you might have said, let's have a bunch of sines and cosines trading. Okay. Then Lagrange, you would have said, let's have a bunch of polynomials trading. Okay, but it's actually a bunch of maxes you trade. And it turns out that's very convenient because of this property that any increasing binary operation distributes over max. So to summarize, we first illustrated Mary Cook valuation with the Black-Scholes model and thought of it as a binary operation, which had some nice properties like commutativity and neutron, but was not associative. And so to get associativity, we switched to the Conjugate model, which turns out is actually a more realistic distribution anyway in many cases. And our new binary operation in the Conjugate model is isomorphic to addition. And moreover, ordinary multiplication distributes over it. And if okay, so the associativity that this alternative model delivers is useful when you have compound options, because basically you can drop the brackets and you get a nicer formula. And that can be the fact that you can combine you can change the order in which you combine. There's also commutativity. Can be helpful, like if you have underflow overflow issues. Okay. Let's say, but that's pretty much it. Okay. So now I made brief reference that you don't have to work on non-negative reals, you can work on reals, you can work on underlines that are bounded, let's say between 0 and 1, or like Einstein's velocities relative to the speed of light between -1 and 1. Those are all possibilities, and there's many more. And focusing on this real underline, the generator you would use to convert ordinary addition into an alternative associated binary operation is log. Okay? And so you would actually have as your binary operation something called log sum exponential. And so I actually have an extensive paper going through all that in case you're interested in further reading. So for further reading, what you can do is take the camera on your phone and take a picture of this. And a website will open. I'm sure you're familiar with this from menus and restaurants. So just, take a photo and then, click through on the link and you'll go to my website and you'll find the paper there. You just have to scroll down with the seminar presentations and you'll find the paper there. Okay. So if you could, I believe you could take a photo now and then figure out a way to get to my website later if you didn't want to go there directly right now. So anyway, okay, so we're going to wrap up. Sorry for going slightly over.
and for skipping some stuff, but, and for the technical issues, but anyway, we got through it. So this is ongoing work. I've actually been thinking about it for 3 years. I started thinking about it with the family. And like, let's say, so far it's been applied to option valuation, but with Umberto Carabini, who's in the second row over there, we're applying it to investment theory as well. So we looked at a well-known investment strategy called Kelly. And let's say that's all about, let's say it's all about working with a model that's basically Black-Scholes model and doing an investment strategy where returns multiply up over time. It's very similar to what I was showing you when I was motivating Stoptions. And we're basically saying that the real world may not be as simple as Kelly first imagined it in the 1950s. So, so we're introducing this notion called stochastic time change, and to be more realistic, but sort of amazingly, all the changes for certain particular time changes is replace multiplication with pseudo multiplication. Okay? And the time changes we use to achieve this are actually well-known examples of random time changes in the literature. So it's kind of connecting various distinct literatures such as investment theory and abstract algebra and probability theory. So historically, I would say probability theory has been, of all the areas in math, the one closest to finance. But we're trying to change that. We're basically, without upsetting the apple cart, we're still doing things like arbitrage free valuation, so it does exist, this is a measure still probability measures, but we're taking a different perspective based on abstract algebra, which, let's face it, when you first thought it, it was not motivated for you, so you probably forgot it. And but it can be motivated, which is kind of exciting. Okay, thanks. All right, so we can go to sort of question phase, if any, both from the room and Zoom. And go ahead, jump here.
Great, thank you for that. I found it particularly interesting that you got an entire ball surface with smile based on what seems to be either the generator function or the goodwill parameter.
Yes.
And I was wondering, for example, if you had market observables that were a different shape,
Yeah.
what were the parameters you would tweak to
Right.
fit that?
Right. Great question. So I'll just repeat it because not everybody can hear it necessarily, although you did speak loudly, which is great. So the basic question is, I showed you the ball surface from that model, conjugate paradigm, and he's correctly saying may not fit. So so the question is, so what would you tweak? And first thing you think of tweaking is that B quantity, because in the model B is constant, okay? It's just the number you know. So just as people went beyond Black-Scholes by randomizing volatility, I can go beyond conjugate paradigm by randomizing B. Okay, I'm actually working on that with someone, and so that would probably create even more curvature. Okay, in case what I showed you was not enough. So the other thing that you can do besides that is just thinking exactly what do we do with Black-Scholes. So another thing that people do with Black-Scholes besides randomizing volatility is they may use shifted log model. Okay, and so I'm sure you're familiar with that. There's a negative interest rate. So shifting log normal is to change the space you're working on. It's no longer 0 to infinity. It could be, say, an interest rate space, maybe minus 100 basis points. Okay, and so likewise, I can change the domain we're working on. Okay, and I didn't actually cover that domain in my list of examples at the end, but you can do it. So semi-infinite domains like that, you say -1 to infinity, you definitely that. And so you'll end up changing things that way as well. So the nature of this presentation has all been distribution as opposed to stochastic process. Okay, I mean, the only time I talk about processes, with Stoption, I talk about discrete time processes, but you can wonder about continuous time processes that support these distributions. Okay, so I just published a paper where we did develop pure jump processes that lead to these distributions. These pure jump processes have independent increments, and so you can motivate these results in continuous time as well if you care. So that's and then like once you have that, it comes back to your question. You can start to thinking like speaking parameters in the process as opposed to parameters in the distribution. Okay. Yeah. Okay, so thanks for that. Any other questions perhaps from Zoom room? Are you monitoring the back? No? Okay. Yes, there's one here. Go ahead.
Thanks for the talk. I'm wondering, so if these binary operation framework and then incorporate into optionality with three alternatives.
Yeah. So the question is, can this framework cover optionality with three alternatives? And actually, the Stoption is meant to address three or more. So three-period Stoption, you have three alternatives. You can start with time 1, or time 2, or time 3. And so definitely yes. But the way you think about more than two alternatives is first, like you have three. First, you combine two. Then having done that, you combine that with the second, with the third. You know, so you 1, 2, and 3, for example. You combine 1 and 2 together, you get a single number, and then you combine that with 3. Okay, so we're always, you can always think of three or more alternatives as, pairwise combined.
But if you think there will still be a linearity.
Yes, it's still going to be linearity. Like the actual formula I showed you for an interior Stoption, if you look at it using the circle plus language, that was actually linear, pseudo-linear in the keys. So definitely that linearity idea applies when there's three or more alternatives. Okay? Yeah. And by the way, you don't have to work with linear. I mean, it happens about linear in this example, but let's say you know the quadratic root point. Okay, you actually don't appreciate it. You can use it with any pair of binary operations that meet the requirements that plus and minus meet. Okay, so in a different problem, you could end up using the quadratic root formula for a quadratic problem that is not the classical quadratic problem. Okay, so you looking at ordinary plus ordinary time is not the quadratic. Okay, so that's another point. And then, okay, I was starting to talk about different applications of investment theory. And just one other thing is, like, we apply this to default as well. So as John Kid in the front of your nose, counterparties default on each other and mitigate the consequences. There's a lot of margin, to pass back and forth. And so it's sort of well understood since actually Merton's 73 that the ability to default is an option. But Merton's model is frankly a toy model, and the reality is people can default, but only they require to post margin. Okay, so the ability to default is an option. And like I said, Bermudan is sort of the last frontier. Everyone has their own understanding of everything else, like barrier options and so on, but not Bermudan or American options. Like, let's say, still no post-one formula for American option in the Black-Scholes model after all these years, and we didn't see one here either. Okay, so anyway, we're starting to get some analytic progress on early exercise through this use of abstract algebra. So excited. And I only showed you Bermudan results here, but with one of the students who graduated last year, Lee Ju, who by coincidence went to Morgan Stanley, we worked out a particular American option. So there's like an American Stoption, and for simplicity, they all scores equal. So we were able to do that. So there's hope. Okay. All right. Thanks again. Okay. Bye, everyone. Have a good evening.